There is a $41 trillion financial time bomb sitting underneath the entire global economy, and no one is speaking about it in the legacy media, but the truth of this catastrophe in waiting has just been exposed by Wall Street insiders with access to behind-the-scenes data. Now, when this ticking time bomb goes off, the economy will be devastated, but more importantly, 90% of the investments that you hold, that I hold, that every other person in the West hold are going to come crashing down. Whether it's property or pension funds or the S&P 500 or even crypto, the entire investment landscape is going to fall apart. And in this video, I'm going to explain exactly what this $41 trillion problem is, what's going on with it, and why you need to know to protect yourself from it. Now, this all starts back in 1975 with an invention by John Bogle. Yes, the first index mutual fund available for any and all investors to buy into and to use. Now, index funds existed before that, yes, but they were for institutional investors only. Rich people, universities, pension funds, big businesses. And Bogle was basically laughed out of the room by most investors for the first couple of decades. But eventually, the advantages of passive investing were clear as day. And so in the end, he basically won the market. And now passive investing is getting bigger and bigger every year, and active is getting smaller. Now, most active funds were losing out to the indexes in the 70s and the 80s, so investors were making more money by just buying an index instead, right? Index funds, they didn't require these super expensive researchers or finance executives they were really cheap to create. And the competition within that space forced fees lower and lower to the point where nowadays the fees for an index fund from Vanguard, right, is 0.15% a year, pennies, compared to hedge funds which are charging 2% flat rates and then a 20% of the profits as well. And then normal active funds like Cathie Wood's ARK Invest and her ETFs, which charge just under 1% per year, which is 500 or 600% more expensive than a passive fund. And for the standard retail investor, right, they're not having to pick the fund, they're not having to judge Cathie Wood and see whether or not she's actually going to manage their money correctly, and they're actually going to pay less in fees and get better results. Why wouldn't they just buy an index fund and get access to the entire market instead? Well, that's exactly what happened slowly over time. And this graph right here shows you the quantity of assets in active funds versus passive funds over the last few decades. In the 1990s, you can see it was practically nothing in passive funds, right? About 1%. And today, we are now moving more and more upwards. Now, this green line, the passive funds, has overtaken the orange line, active funds, which means more than 50% of every dollar invested into the stock market today is in a passively managed fund. And it's growing. That ratio is increasing a lot faster than this orange line here, and we expect that around about 2030, that number is going to reach 70%. And this makes sense, right? Everywhere you look, the advice is just buy the S&P 500 index fund. It's the gold standard. It outperforms active funds or active investing. It's cheap, dollar cost average. Don't try to time the market. Don't, look for the needle in the haystack. Just buy the haystack, all of this stuff. The problem is that actually passive investing, too much of it, is literally breaking the markets, and it's now created this $41 trillion ticking time bomb that will at some point explode. And to show you just how serious this is a quote from an academic researcher who put out an entire paper establishing just how much damage passive investing has done to the market. This is what he had to say. If an active manager thinks that a company is overvalued by the market, then they may choose not to hold it at all. But a passive fund would hold it with a high weight. What he means by this is that every day more and more dollars are going to passive investing than active investing, which means price discovery isn't really existing in the stock markets anymore. The way an investment really should be made is, what is this company? What do they do? What do they make? What do they sell? How much do they make? What are their costs? And how much are they going to be able to return to me in the future as a shareholder? What are they going to do in the future? Are they going to be attacked by the government, or is deregulation going to make them richer? Are they going to grow or shrink? More efficient, less efficient? And based on all of that information there, I'm going to say I'm willing to pay a certain amount per share, really based on the direct return I expect to get from that investment. And really, fundamentally, this is the way all investments work. Whether you're buying a stock or an investment property or a bond, what gives these investments value is the prospect of receiving a portion of the profits from the asset, right? If there are no dividends, no rents, no returns, then in theory, the value of that asset should be close to zero. But plenty of companies don't pay dividends and never had, though they're still valued into the billions and much more than that. Well, yes, that's because they have the potential or the ability to pay out huge profits and returns to investors. Now, active funds are allocated based on what those companies are doing right now and what they might be able to do in the future. Passive funds are just thrown at the wall with an inherent trust that everyone else investing in the markets, they're paying attention, they're choosing where to put their money. And so there's this really big misconception about passive investing where people think it's impossible to beat the market. It's impossible for an actively managed fund to do better than a passively managed fund. Well, really, when you buy the S&P 500, you are just buying into an index of all the actively managed funds, or at least you used to be in the past. But you don't have to pay any of them directly because you're just buying what they're buying and you're just copying them. Because as they invest into something, they push the value up, you then buy it through your index fund, and it all sort of evens out. But what happens when there's too much passive investing and there aren't enough active investors, price discoverers going out there working out what's good about this company and what's bad about it? Well, active investing stops leading the markets and passive investing leads instead. And we lose price discovery, right? Right now, there are not enough people actually caring about the insides of a company that they're buying or selling. And those people who are caring, they're outweighed by the people who just buy a stock in a company because it's big already, passive investors. And actually, we've created now this horrid positive feedback loop, a doom loop, from passive investing, where people allocate a higher proportion of their capital to the largest companies, which then get larger because that's where the buy and demand is going. And so then their price increases, and then the next bit of capital that comes into the markets, well, that's in passive funds, that's going to do the same. And you get this positive feedback loop causing the largest companies to just keep growing forever. And we can see that going back to this graph here, when passive investing really started to take off was around the 2000s or 2010s when it started to get really, really popular. And that's also, funnily enough, when this idea of FANG stocks first took off as well. Facebook, Apple, Amazon, Netflix, Google, the big American tech companies that dominated the S&P 500 before and therefore dominated global equities in general, to the point where FANG alone in the 2020, around that point, made up about 15% of the S&P 500. Then we had COVID and the AI boom and things changed a bit. Netflix is no longer important because it's media, not tech, always was. And FANG has now been replaced by Mag 7, the Magnificent 7 stocks. Facebook, Apple, Amazon, Google, Microsoft, Nvidia, Tesla, maybe Broadcom in there as well. People debate about it. But that's the benchmark, the 7 kings of the stock market today. How much of the S&P 500 is made up of those 7 companies? Well, that's exactly what this red line shows you here. It's Magnificent 7's market cap as a percentage of the S&P 500's market cap. And you can see very, very clearly a monstrous increase in that over time. Let's not forget that, FANG was just a part of Mag 7, and Mag 7 is basically all of FANG today. So you can see it was only 10% or so in the late 2000s, late 2010s. Going up, explodes over COVID, 27% now, 30% around about the last year, peaking now at 35% of the market right now is made up of Mag 7. Of the $55 trillion in the S&P 500, split between about 500 companies, $21 trillion of that, or about 35% of its value, is in just 7 companies. When you buy into the S&P 500, more than a third of your money goes towards these 7 companies, but most people investing don't know this. Most people don't even know what some of these companies do. Most of them probably have never even heard of Broadcom, have no idea how much they're worth or what their PE ratios are. But the passive investing inflows keep going in and keep making these companies grow, causing that positive feedback loop, causing them to grow more than ever. More money is now coming in passive than active, let's not forget that, which means active is being outweighed by passive. And price discovery doesn't actually really exist in the markets anymore. The markets are no longer efficient ecosystems made up of millions of individual decisions every day. They're just one big pot of money spread out, almost at random. And that's caused the undisputable passive investing bubble that exists today, right? What's the underlying cause of all value within the markets? The potential for an asset to pay their investor a return, a dividend, a profit, a yield. All of that comes from profit. So a price to earnings ratio or a forward price to earnings ratio is the easiest determinant of true value in the markets. Now ask the average person, right, if they were to invest in something today, how long would they want until they've had that initial investment returned in profits? They're probably going to say something like 10 to 20 years as that reasonable level, as that average. And funnily enough, that actually aligns perfectly with the average PE ratios of publicly traded companies for most of history, right? And we can see that right here. This is the PE ratio of the S&P 500 since 1930. 10 is this level down here, 20 is this level up here. Throughout most of history, it has sat between those two lines. When it gets a little bit higher, there's a crash, like the Great Depression. When it gets a little bit lower, there's then a boom, like the 50s and the 60s, where stock prices come up, and so on and so forth. That is until actually we get into around about the late 90s and the 2000s, when passive investing starts to have an impact on the markets and starts to get really, really popular. We see that actually the PE ratio is averaging between 20 and 40, not 10 and 20. Now, is investor psychology different today? Are people willing to accept lower returns from their investments today? Are people willing to not get their money back for an extra 15 years today? No, of course not. None of that has changed. But what has changed is there are fewer people actually knowing what the returns of their assets are in a true sense. Value used to be dependent on the profits and the returns and the stability and future of a company. Now, investors think that the value of a company is its price. And so if the price has gone up, well, their value must have went up as well. If the S&P 500 went up, I'm richer. My assets are better than ever before, even if the underlying assets are literally the exact same, or in some cases, actually worse. Now, this is delusion, but it's delusion en masse. And because most people think like this, the markets behave like this. Again, where does 1/3 of all the money you put into the S&P 500 actually go? Well, into the Magnificent Seven. What's the forward price to sales ratio for the Magnificent Seven versus the S&P 500? Just how overvalued are those 7 companies? Well, for the Mag 7, the forward PS ratio is 8 compared to 2.5 for the rest of the S&P 500. So about 2.5 times higher than the rest of the market. What about forward PE ratios, price to earnings ratios? Well, it's about 30 for the Magnificent Seven, and it's about 20 for the S&P 500. So about 50% higher than the rest of the market. Or what about the growth in price of Magnificent Seven stocks in general since this AI bubble started? It's 20 times higher in some cases than the S&P 500. Not a single one grew slower than the rest. Now, this is without a doubt a bubble caused by passive investing and indistinct a lack of price discovery. Now, fiat currency is struggling all over, right? The euro, the pound, the dollar, they've all had crazy inflation in recent years. De-dollarization of the world is taking its toll. More and more people are looking for non-inflationary assets to try and protect their wealth. And people like myself, in particular, are turning to cryptocurrency for that. Now, Dogecoin is probably a name you've heard before. It's Elon Musk's favorite crypto. It's the 6th largest in the world with a market cap of around about $30 billion with billions in monthly trading volume. And that brings me on to this video's sponsor, House of Doge, trading under the ticker symbol TBH, which is the official commercial partner and commercial arm of the Dogecoin Foundation, tasked with bringing Doge utility into the real world, away from its meme coin roots and towards a real global digital currency, just as Elon Musk has been pushing for. Now, the CEO of the House of Doge was before the CEO of Payfair, which was recently acquired by Fiserv for $200 million. And now Doge is integrating with Fiserv, a Fortune 500 company which focuses on payment processing, banking technology, and merchant services. This could be huge for Dogecoin because Fiserv could enable Doge payments at merchants worldwide. They could provide the back-end tech for a Doge-centric neobank. They could make Doge spending as easy as swiping a card or using Apple Pay. And the other really exciting thing about House of Doge is that they also own a part of CleanCore Solutions, a company that wants to be the go-to stock for investors who want exposure to Doge's upside and are the official Dogecoin treasury. Just like how MicroStrategy became a company that allows easy and tax-efficient investment into Bitcoin and became a $90 billion company in the process, Zone are working to do the same thing for Dogecoin. CleanCore Solutions are working to do the same thing for Dogecoin after raising $175 million and buying more than 600 million Doge so far, with a target of 1 billion within 30 days of their fundraising. Of course, do your own due diligence, but do learn more about House of Doge trading on the Nasdaq under the ticker symbol TBH and CleanCore Solutions, who trade on the NYSE under the ticker symbol ZONE. But definitely give them both a closer look by clicking on the link down below in the description, because this looks like a very interesting opportunity. Now, it's obvious there's a bubble here in the passive investing sphere, right? The S&P 500, it doesn't grow on news or fundamentals anymore. It's not getting more valuable because the companies are doing better. It's getting more valuable because every day more people are investing money into it. It's inflows versus outflows, and as long as those inflows are larger, then the S&P 500 will grow. What happens though when the inflows go down or the outflows go up? Well, that positive feedback loop which causes the S&P 500 to grow without direction will work in the other way. More money will be leaving the index, the S&P 500, than is entering it, and so there'll be more selling pressure than buying pressure. And prices will go down, even if the companies are growing and doing better. Because again, these people taking their money out of the markets now, they aren't selling because they don't like the stocks. They aren't selling because they need the money for a house or a retirement or something else. There's no price discovery to go on. Now, the biggest companies will get hit the hardest, right? Magnificent Seven, they benefited the most from the inflows. They will suffer much more than smaller companies from net outflows as well. And then the idea of passive investing stops holding up to scrutiny at all. And people see lower returns and they lose trust in that now infamous statement, buy and hold, don't try to time the market, and they start selling extra. And the outflows get larger and prices drop even faster and the doom loop spirals down and gets worse and worse. And all of this would simply be caused by people adding less to their investments and taking money out instead, which is actually incredibly easy to see happen. When does the average investor stop investing and start withdrawing? Well, the main reason is when they retire and they start living off their investments. The average age for retirement for the United States is 62, for the UK 64, the EU 63 or thereabouts. And when someone becomes a net outflow, that's when the passive investing feedback loop switches around. But we know all Western nations have aging demographics, right? The average age in a country like South Korea is now 46. In Japan, it's 50. In America, in the UK, and Europe, it's around about 40 or a little bit above that. But that number's going up every single year. Now, so far, it's been kept low in Europe and North America because of mass immigration of young people, but there's this subtle revolution that's been happening against mass immigration, and the rates of immigration will reduce to a huge degree in first world nations over the coming years. So the average age of our countries is going to start going up even more, closer and closer to that age of net outflows in the early 60s. But still, just by demographics alone, we are a long way from the average age of our countries being 65. So demographics alone are not going to cause net outflows from these passive investing doom loops and create this whole problem. But what's another reason people change from a net inflow, a net contributor, a net investor to the S&P 500 to someone pulling their money out, a net outflow? Well, unemployment, not having a job, still needing to pay for rent or a mortgage or a car payment or school or food or insurance or everything else. And when people lose their jobs, they start pulling money out of their investments instead of putting them in. But usually at a much greater rate than they invested, right? Most people are putting 5, maybe 10% of their income into investments and they're spending the other 80%. But when they lose their job, they need to pull out the equivalent of what they used to be earning to keep themselves from going bankrupt. So it can be 10 times as much as they used to invest. One unemployed investor creates as much outflows as around 10 employed investors. But again, that would require us to reach unemployment levels of, say, 10% for that balance to be knocked out of whack. So unless there's a black swan event that changes the employment market forever, that causes mass layoffs and a recession right as our population gets older than ever before, we're probably fine. But that's when you start to think about what's been happening in the economy over the last couple of years and the AI threat becomes very real, right? AI is real. Its advantages can be incredible. Just for a little bit of context, I'm in the process of building an AI for investors right now. I have literally one coder working on it, using AI, building as quickly as a team of 10 people used to be able to do 5 or 10 years ago. And not every industry is susceptible to AI yet, but most low-level digital jobs really are at risk. Interns and assistants at law and accounting and simple services that are already done online, the fear and the risk is that these jobs are incredibly replaceable by an AI, and that could lead to mass layoffs in First World War countries. Now, in a place like the United States, the Brookings Institute has already done this research for me, and they found that 26% of jobs in the US are highly digital. Highly digital. Which means that they have a high chance of being replaceable compared to AI. Maybe a third of these people being made unemployed and replaced by AI over the next 5 years really isn't that ridiculous. That alone could be enough to reach that 10% unemployment rate to create the doom loop. And even ignoring the fact that 10% unemployment would cause a massive recession, and that would cause more job losses and less investment and lower economic growth, the actual companies making up these passive funds, well, they would lose revenue and profits, and active investors would sell. And this doom loop really starts to seem inevitable. And that's where these Wall Street insiders are sounding the alarm, because they explicitly say that when unemployment in the US reaches between 5 and 6%, that's when they think outflows will be greater than inflows and the doom loop will start. These Wall Street insiders who also say that the AI revolution over the next few years could cause as much as 10% unemployment in the United States alone, easily enough to reach that 5 to 6% mark for the doom loop to start. So this black swan event may be coming far, far quicker than we ever expected before. Just how bad could it be? Well, the S&P 500's PE ratio right now, including the Magnificent Seven, is about 27. And these historical averages, or these, I should say, true fair values for blue chip companies like those in the S&P 500, that's around 10 and 20. So if the S&P 500 were revalued today at a PE of 20, that would be a 26% drop in the S&P 500, worth more than $14 trillion in losses. If it were revalued today at that pre-passive investing average of around 15, that would be a drop of 45%, or about $24 trillion. And if the S&P 500 went to the bottom of that historical average with a PE ratio of just 10, that would be a drop of 63%, costing the S&P and net wealth of those investors, $35 trillion US dollars. And then what if we added on top of that the impact of a recession? If we added into the impact of the GDP and the economy, well, the 2008 recession took about 3.5% of the US GDP off the country. COVID took off a massive 9%, but let's be honest, that was artificial and not a real recession. So let's be generous and say that the companies within the S&P 500 lost just 10% of their earnings, just 10% of their profits, at the exact same time as the S&P 500 was revalued thanks to the passive investing doom loop unwinding and being a catastrophe. It settled at around a PE ratio of 10. That would be equivalent to a 73% crash in share prices. That would cost the S&P 500 a monstrous 41 trillion US dollars. That would be the worst market crash in outright figures in history, without a doubt. But the worrying thing about this is only about 10% of that would be due to an actual change in the companies themselves or recession. 90% of that drop would purely be due to the passive investing bubble going in the other direction, and investors finally actually caring about what they're buying instead of just going into passive funds and the S&P 500 buy and hold just for the sake of it. Now, the good thing about this is I really don't think we're there yet. 90% of companies, they aren't actually using AI properly, and the AI itself isn't good enough to fire that much of the workforce. It still needs coddling and improvements, but it is going to get a lot better over the next 5 years. And if AI keeps getting as good as it has been and developing at the same rate over the coming few years, this reality is very possible before the end of this decade. So I do think it's very, very important that we take this seriously and we understand the risks of the passive investing bubble. Now, if you want to hear about financial, economic, geopolitical news before everyone else, click the link down below and you can sign up for my email newsletter for free. I don't have to record and edit these whole videos together, so I'm able to get content out to you far, far quicker, making sure that you're ahead of the rest of the crowd. The link to join for free is down below in the description. You can, of course, cancel and unsubscribe any time, no questions asked. Or you can even click that link down below to check out what some of my readers have to say about the free newsletter and then sign up and start getting educated from email.